Let's talk interest rates. Interest rates were crazy low for 15 years in the United States. There was one thing after another that happened that led to the manipulation of interest rates down to abnormally low levels that you and I got used to. And you think about that 15-year period, if I was a saver, I got eaten alive. I mean, just destroyed, because I couldn't earn anything on my money at all. At the same time, it was the most borrower-friendly market ever. Ever. I mean, crazy low rates. We've talked about the ultra-low mortgage rates. We don't talk a lot about how cheap car loan rates were if you went to a credit union, with rates in the ones for people with good credit scores. 1 point something percent. I mean, that's nuts. And so we had this unusual time, but we paid for it in a number of ways besides just savers paying. Think about what we went through from 2007 to about 2013 with the ugly levels of unemployment, the foreclosures in the United States, all of that as a result of the banking scandals that came to a head in 2007-8. And so it wasn't worth it. It wasn't worth it to have those artificially low rates. And then we went through another cycle of low rates because of COVID, where the Federal Reserve was manipulating rates down. And then we got this cycle of inflation. And the inflationary cycle that was looking so dangerous a year, 18 months ago, whatever, that scary inflation's been broken, but the impact already happened. So even though inflation is heavily reduced from where it was, think what's happened. The prices we're paying for things are now higher. And only some of those prices are what they call elastic, that they'll go back down. Because once prices hit a level, they may not go up at all like they were before. But it's unusual in most product categories for goods and services that once prices have achieved, once they've reached a new level, they normally don't cycle back down. And we are looking towards an era with inflation somewhere 2.5% to maybe 2.75% is the trend line of where we're headed. And that's what the bond market is pricing in. But the interest rates we're having now are going to be higher moving forward than what we've been used to over these last 15 years because of a couple of reasons. One, we're normalizing, where we're getting into interest rates that are more normal based on economic activity and the economy. And so we will see decent rates for savers. We'll see more expensive rates for borrowers, for mortgages, car loans, student loans, whatever. We'll see these higher rates. Credit card rates aren't really as interest rate sensitive as these others. They're much higher rates. And I shared with you recently this thing that bank credit card interest rates are averaging 22%, credit union credit card interest rates averaging 12%. And it is not normal market-based pricing with credit cards because people don't take out a credit card intending to borrow on it. They just expect it to be a payment system. So they're not paying attention to the interest rates, which is why the banks make those so high. But there's one other factor that mixes into all this, and it's the huge national debt we have in the United States and the ongoing running deficits we're running in the United States, those things, the cumulative debt and the annual deficits, are leading to higher interest rates in our economy. And as long as the people who invest or save through bonds or bond funds are skeptical that the U.S. government will get its act together on what we're spending each year and our cumulative deficit, it's going to force us to pay higher interest rates on the U.S. debt. Because if lenders, which is what you and I are, big institutions, when they buy instruments like U.S. Treasuries, bonds, bills, whatever, when you buy those, you have to anticipate the supply that are going to be available and how much is out there, the supply we have to absorb. That has the effect of excess supply of debt, means that the interest rates that have to be paid to attract people that will buy them has to go up. I mean, it's crazy how much economic benefit our economy would have if we got our act together in Washington and we got the federal spending versus revenue coming in under control. But unless and until we do, the whole economy suffers from higher interest rates. Again, beneficial to savers, harmful to the overall economy, and very harmful to borrowers and ultimate economic growth. So I hope at some point, as they refer to it in politics, we get enough adults in the room that they do something about the extreme budget deficits and the cumulative federal deficit or debt, because that is having an impact on what you and I have to pay when we need to borrow money.